All right, Accounting 2 kids, we are ready for chapter 19 now. 19 actually has 6 sections. It's one of our longest chapters ever. And so we're going to start out with talking about buying plant assets and how to pay property taxes. So let's dig in. First off, plant assets. Remember that when we're talking about plant assets, we're talking about physical assets that are used for a number of years in the operation of a business. Some of our common categories for plant assets include equipment, buildings, and land. Now, most of those are also going to be broken down even further. So let's take equipment, for example. We might also have accounts for office equipment, store equipment, warehouse equipment, and transportation equipment, and each of those then have its own account. So when a company buys a plant asset, its whole expectation is that that asset is going to help the company earn revenue or money. So the problem being with that is that since companies do have limited resources, meaning money, to invest in plant assets, oftentimes managers have to make a decision between which investment opportunities are going to be the best for that business. And using accounting and the data we can collect, we can help make better predictions about the efficiency of an investment. So one of the most common ratios that we use when we're talking about that is something called ROI, or return on an investment. And essentially it's the ratio of the money earned from that investment relative to the amount of the investment. So essentially, how much is it making versus how much did we pay for it? The more efficient an investment is, the higher its ROI is going to be. And obviously, we do this to try to help managers make better predictions about which asset is going to be the best for our company to buy. Now, most plant assets are useful for only a limited period of time. Nothing lasts forever. And over time, this equipment is either going to wear out or it might become technologically outdated. So, for example, if you have a truck, which would be transportation equipment, that truck isn't going to run forever. Eventually, it will wear out. Same thing with technologically outdated. If you buy a computer or bought a computer in the 1980s, it likely isn't going to be uh, useful right now technologically because technology has come so far in 40 plus years. Okay, so regardless of the reason, however, the cost of a plant asset has to be depreciated over its entire useful life. So each plant asset is actually going to have a related accumulated depreciation account, which is a contra asset account used to accumulate the annual depreciation expense of that plant asset. So the first thing we need to make sure we know how to record is how to record the buying of a plant asset. So on January 3rd, our company paid cash for a shelving unit for $8,500. So our store equipment is going to go up, cash goes down, regardless of the actual value of the plant asset. So let's say that shelving unit is actually worth $10,000, but we only paid $8,500. We always record the buying of a plant asset at its original cost, which is the accounting concept historical cost. So that's obviously going to go in our cash payments journal. Store equipment is the account title general debit, and cash gets a credit. Now, there might be times where a company can buy several assets as a group, and usually when you do that, it's called bundling, and you get a better or discounted price when you purchase more than one asset. And so even though you're only going to pay one price for a number of assets, each asset has to be assigned or allocated a specific price. The cost allocated to each asset is going to be debited to that plant asset account. And we have to make sure that we have this so that we can depreciate each item individually. So when we buy as a group, the first thing is we have to calculate the total estimated value of all of our assets bought together. So when we look at this, if for example our company buys a copy machine and a display case for a total cost of $27,000, the copy machine has an estimated value of $7,500 and the display case has an estimated value of $22,500. So we take the estimated value of asset 1 and the estimated value of asset 2, and we get our total estimated value of all of our assets bought together. So even though we only paid $27,000, we need to make sure we know how much of these two together, $7,500 and $2,250, total for our estimated value of our assets. So we have an estimated value of $30,000. Okay. Then we go over here to calculating the cost assigned to our copy machine. So we take our estimated value of asset number 1 and we divide it by the total estimated value of all of our assets bought together. So remember, asset number 1 was our copy machine at $7,500. That's what we paid for it. And the total estimated value of all of our assets bought together are $30,000. So if you do that calculation, it winds up being 25%. We then take that 25% times our total purchase price, and we get an office or a cost assigned for our office equipment, which is the copy machine, of $6,750. And then we need to do the same thing for our display case. So remember, our estimated value of asset number 2 was $22,500. And the estimate of those two together was $30,000. So when we do that calculation, it's 75%. Then we go ahead and we take our total purchase price of $27,000, divide it by our 75%, and we wind up with a cost of $20,250 for our display case. Then what happens is we record that in our cash payments journal. So we bought a copy machine and a display case for $27,000. But the value of that is what we just found previously, which was $67.50, and our store equipment was $20,250. So those are our allocated amounts that we had just found. So those two are getting debited, and then our cash is being credited. Now, for some reason, my graphic didn't download from our company, but we know that this goes in the cash payments. So office equipment would be debited, and store equipment would be debited, and cash would be credited. You guys should know how to do that. Now, for tax purposes, state and federal governments define two kinds of property. There's real property and there's personal property. Anything that is land and anything attached to that land we call real property. So this is most commonly referred to as real estate outside of the business world. In business, we refer to it as real property, but really it just means like land and anything that's attached to the land, like a building, a shed, a store. Any of those would be considered real property. And all property not classified as real estate or real property we call personal property. So that would be things like cars, boats, trucks, anything else that would be considered a plant asset that isn't land or a building is considered personal property. Now, most government units that have the power to tax, whether that's local governments, state governments, federal governments, they impose taxes based on the value of real property. And real property taxes get assessed on buildings and land. Okay, that's most common. You're going to pay property taxes on those. It's very rare that you pay property taxes on things like boats, cars, trucks, things like that. But there are some government agencies that do that. So just be aware that that may happen with your business. But most of the time when we're talking about property tax, we're talking about paying on land and buildings. Now, the value of an asset that gets determined by tax authorities for the purpose of calculating taxes is called assessed value. An assessed value is usually based on the judgment of an official that we refer to as assessors. So there are people's jobs that come out and they take a look at your building and they take a look at their land and they have something called an assessed value. And when we calculate property tax, there is a tax rate that is associated with the assessed value in order for us to calculate this. Now, the tax rate is multiplied by the asset's assessed value, not by the value recorded in a business record. So that's very important to remember when you're calculating property taxes. It's always based on the assessed value, not what you actually paid for it. So when we take a look at this, let's say we bought a piece of land and we really paid $60,000 for it, but an assessor came out one year and said that the assessed value is $80,000. That's what we pay taxes on. So if the assessed value is 80 and the tax rate is 1.3, when we do that calculation, we wind up with annual property tax of $1,040. So our property tax expense will go up, cash will go down with a credit, and that will go in our cash payments journal. So in 19.1, we're buying plant assets. We are talking about buying a group of plant assets and then allocating their cost, and then also paying property taxes. So we'll head over to our work together video next to do section 19